Today, I'm going to tell you about hedge funds. We've learned a lot of things in this course. We started with bonds, then we learned a lot of things about pricing options, and then we saw about risk management and credit risk. Last week, we learned about investing and what that's all about and what that involves. And today I want to focus on a type of investing which will be good for you to know. I don't know how many of you will have jobs in the hedge fund industry. I don't know how many of you will start your own hedge fund. But I do know that throughout your career, you're going to run into hedge funds all the time. Sometimes as your client, sometimes as your service provider, sometimes as your competitor. And I want you to understand how that world works. The hedge fund industry is somewhere around the area of $4 trillion, so it's like the economy of Japan. You cannot ignore it. It's a very specialized industry. No two hedge funds are really alike. They're all different. What I want to do today is I want to give you enough information so that you can learn what that's all about. I'm not going to cover 0.1% of the space. But when it comes to the philosophy of what they do and the decisions they make and why, I will cover maybe 70% of that. Okay, so from a philosophical perspective, today's class will be very useful, very effective. I've spent a lifetime investing in hedge funds. I've been doing that for 15 years. I invested about $1 billion total, not maybe $3-4 billion allocation. I know them very well. And I want you to know them as well as possible within the 3 hours that I will be allocating to this today. So what is a hedge fund? There's some characteristics to hedge funds. What they do is, like every other investment, is they take risk into return. We saw that last week. Every act of investing is taking risk into return. And you need to know what risks you're taking. That's where risk management is so important, not from a regulatory perspective. In this case, is to understand what are the risks that you're taking and whether you're compensated for those risks appropriately. That is something which we started last week. Today is going to become very, very clear in specific examples that I'll show you. And that risk that you take, that you turn into return, in the particular case of hedge funds, is usually arising from two sources, either market inefficiencies or information advantages. And we'll see examples of that. Market inefficiencies, we can go back to our snow fund example of last week. That's an example of a market inefficiency. Why? Because the city and the ski resort did not realize that their objections to that particular deal was very easily fixed. And no one else knew. So you show up and say, well, I'll do it. Imagine everybody knew. Then if you're not the only one saying, no, I'll do it, if everybody and their cousin shows up saying, I'll do it too, then there will be a battle for pricing, and then you don't get to charge 10%. I said, you know what? It's not worth it. Then you don't do it, right? That's one way to do that. The other is to have information advantage, not to be misunderstood with the use of material non-public information. That's illegal. But information advantage, you know something that other people don't know. Or if you have a different perspective on things, you may think that a certain drug is just not going to work. And there's a lot of hype about that particular company doing that drug, so that's not going to work. And because of A, B, C, and D, it's not going to work. And it's going to be shut down because of this and that, and then you go short, and then you make money. That's another example of how you do that. Now, there's another way of investing, which is, you know what? I just buy the S&P 500, and I just enjoy that, right? If it goes up and if it goes down, I have a beer. That's not a hedge fund. At least that's not a hedge fund according to the definition that we're going to be dealing with here. So I'm not taking that into account. That is not the type of investing I'm going to do, which is, I buy the S&P 500, it's dropped a lot. I invoke some stop loss policy, and then I I redeem everything, I turn into cash, I lost 10%. Oh, I'm sorry. That's not what I'm talking about. Okay, hedge funds is a different type of strategy. And in particular, you will see that the aim is not to profit from any particular market direction, understood properly. All of these things will have a lot of color and flavors, and it's very hard to generalize, but I have to start somewhere. And we'll see examples of all of that, even examples where what I'm telling you here is actually incorrect, is an oversimplification. By the end of today, I think all of this will become very clear to you, the precise meaning of these things. And they will use whatever securities are available. Sometimes they will be exchange traded, sometimes not. They would do over-the-counter derivatives. They would do very sophisticated derivatives, and we may see some examples of that. And they may have a limited opportunity set. Like, for example, let's go back to the example of last week. We saw the Snow Fund. Was that an exchange-traded security, the Snow Swap? No, it was not. In fact, we had no idea how to even price it. Was it an over-the-counter security? It's not even clear it's a security. It's a contract, right, for payment. So, and we had a limited opportunity set. We did an analysis, and the most we could invest was $2 billion, and that's it. That's very typical, right? Whereas if you want to invest in the stock market, how much can you invest? Volumes are gigantic, right? And sometimes they come with liquidity restrictions. In fact, if I said that investing is taking risk into return, sometimes that risk is in the form of liquidity risk. You're going to make money, but you can't touch that position for 10 years. That's an example. And they're often innovative. This is, by the way, what gives them sometimes such good press. They tend to do things before anybody else does them. We already saw an example of that. Remember that credit trade we did here? I forgot who, but two credit traders were. One was a bank, one was a hedge fund. Remember? You were the bank, right? So you were subject to regulatory constraints. You could not pay more than $6.50 for that. I forgot what was my hedge fund, but the hedge fund could go all the way up to almost $8 for that. So if the hedge fund offers something like $7, they make $1. You can't participate. It's too much for you. Right? And people say, okay, today I'm going to talk a lot about what people say, because, and by people I don't mean people in the, Queen Street. I'm talking about even experts on finance. They don't understand hedge funds very well, and that's what I mean by people. I want to demystify a lot of what people think hedge funds are. And they sometimes people say that they are unregulated. And as we discussed last week, they're not exactly unregulated, they are self-regulated, which is if the investors like the regulations they have, they go in. If they don't like it, they don't go. But usually there is no authority that says, oh, you did, that's a very risky trade. So what? It's not your business, it's my investor's business. Yes?
Well, you mentioned there are liquidity restrictions.
Sometimes, could be, but not
Where
always.
is it from? Is it because they don't want it?
I'll give you the example of the Snow Swap. Remember the Snow Swap? Okay. So the Snow Swap is an agreement I have with the city and the ski resort. And typically that Snow Swap makes sense if you hold it for a year, right? And we went through that already. Remember, I said, well, what if you want to, I had a very rich investor in class, $500 million was invested in the fund. If this person wants to sell, what do I say? No, you can't. And I will have some liquidity restrictions that no one can get their money in less than a year. In fact, if you want to get your money at some point, you better tell me ahead of time, right? And so a typical liquidity restriction could be something like this. You want to get your money, you can get it at the end of every December, but you have to tell me by June. Why? Because I have securities that may require a lot of work to unwind, right? Okay, so there's no swap. If I'm going to renegotiate my deal with the City of Montreal next year, and I negotiate in August, I need to know, like in July, how much money I have. and whether they have to drop this swap or to drop that swap, right? If you have to buy and sell stock, you can do it in a day, unless you're very big, in which case you may have also some restrictions. But oftentimes, hedge funds, they look for those special opportunities that require time, and sometimes you're locked into a deal. Let's say another example that your hedge fund, we're going to see examples of that today. Let's say that your hedge fund is going to, this actually happened. Air Canada was about to file for bankruptcy a while ago. Let's say that they filed for, they were somehow invested by a hedge fund, Cerberus, a hedge fund in New York, right? If you're going to tend to do, oh, wait, my investor wants the money back, you can't go into a deal not knowing how much money you have, right? Another example. If you're running a mutual fund and people want their money tomorrow, big deal, you sell it. That's it, right? There's a lot of liquidity, but in many of the deals the hedge funds will do, the liquidity is sometimes the source of return. So you don't want to hurt your other investors by rushing into a liquidation, for example, when not convenient. And we'll see examples of that today. Clear? Yeah? Good. I encourage you to ask as many questions as you want today. Like I said, this is something, I don't know how many of you will work in a hedge fund, but do believe me, you will be related to a hedge fund several times throughout your career. You better understand how they work, okay? Now I have here it's a scattergram of hedge fund strategies. I won't go through them. I just want to show you that there's a lot of variety. Look at the risk is in the x-axis and the return is on the y-axis. They're all very different. They're all very different. They don't just accumulate there. They all do very, very different things. And not only within a strategy, even within a strategy, inside the strategy, you could have a hedge fund that does convertible arbitrage and they make money today, and this one does convertible arbitrage and they lose money today. Okay? So the correlations are very, very low. We'll see that. Lots of different strategies, lots of different names that some of them have become very popular, like merger arbitrage. What is that? Well, if we have time, we'll see an example today of that. But the majority of these strategies are equity-based. Equity markets are the ones that, they're not necessarily the biggest markets, but they're the ones that attract the biggest number of hedge fund strategies. And I'll be talking a little bit about that today. In fact, I want to start with a long equity investment. Then I'll talk about short equity investments, and then I'll talk about long short. And that will be the interesting part. That will be where all of the characteristics of a hedge fund thinking, acting, and investing are going to come up. All right. The first type that I want to discuss is fundamental equity trading, and perhaps that's best represented by the picture of Warren Buffett. Fundamental equity, I like to say it started around the year 1930. This is when this thing called value investing goes back to. You may have heard what that is. I'll tell you a little bit about that today. And I believe I've said this before, and I want to repeat it again. There was a fundamental advancement that made this possible, and that was the creation of trusted accounting principles. Equity trading, fundamental equity trading, uses accounting information to make decisions. I'll show you examples. But for that, you need accounting to be trusted. Today, we take it for granted. If a publicly traded company lies on their financials, that's a very big deal. Someone will go to jail. It wasn't always like that. It wasn't always like that. So you should be aware that whenever they say revolution, there's changes. And this is the revolution that made this style of investment possible. The fact that accounting standards exist. GAAP standards exist. Generally accepted accounting principles exist. If I don't know how many of you have taken accounting. You've taken accounting. Okay, I don't know what you thought about accounting, but let me tell you, I don't know what they taught you, but accounting was the revolution that allowed for this type of investment to actually happen. I mean, there's one thing you need to remember from whatever accounting class you took, is that there's a logic to numbers, a logic which is enforced by law. And this is what makes this type of investment possible. Now, the next one is growth. Fundamental does not look into the future. Accounting does not look into the future, right? You saw that. It looks into the past and maybe the present. So what happens? How can you take advantage of, for example, the case of Microsoft in 2003, which I will explain in a few minutes? How can you take advantage of that from a fundamental accounting analysis perspective? You can't. You can't, because you look at the accounting of Microsoft in 2003 and it doesn't look very attractive, not from that perspective. But something tells you, and we will see what metrics will tell you, that no, that's about to change, and then you'll be late, right? So we'll go through that. Of course, as you know, all these things, fundamental investors, they typically do not like to get into spaces like, for example, tech, biotech, things like that, where accounting, I mean, who would buy Facebook at the IPO when their revenue was $0 per year?
VC firms.
Sorry?
VC?
Yeah, well, that's the thing. See, that's a growth trade. You don't buy that because Facebook was such a great company at the IPO, not from the fundamental perspective like a Warren Buffett would look at, right? Warren Buffett will never buy a company that has $0 of revenue, right? But you understand that could be that's a different type of investing. It's called growth. Then we have GARP. GARP means growth at a reasonable price, and it's somewhere in between the two. Of course, people recognize that fundamental investing has merit, but also growth investing has merit. And how do you decide which one to look? So if sometimes it's not a 0-1 decision, right? So you would make, is Tesla a good investment? Tesla has some growth elements to it and some fundamental elements to it. So you want to weigh them somehow. That would be a GARP trade. But now, and this is how things have been for the past. But I want to talk about two styles which are very interesting. The first is momentum trading. Momentum trading is you buying something because it's just going up. Everybody's going to buy it. You buy it, and then you just enjoy that ride. And then at some point, there's a momentum reversal. You better get out. What's driving this is, this is a socially driven style, and that's what it makes it so interesting for us today. In the past, socially driven strategies were a minority, and because who can know what a social trend is? But now you can. Now you can. The example that is typically listed as the epitome of momentum trading is Netflix in 2013. Even the CEO of Netflix said that it was being the subject to it was a momentum stock. Okay, it was investors just everything that happened around the year 2013 in Netflix was very, very interesting. I don't have time to explain everything to you, but it's very, very. But from a momentum perspective, many people just saw that Netflix stock was going up and up and up, and many people just go and say, you buy it. Why? I don't know. Everybody's doing it, right? The best example of that for me is GameStop. That's a very famous momentum trade of a different type. Okay, much more short-lived, and I think you know a lot about that yourselves, so I don't have to tell you. And you probably start to surmise the fact that if this was a mysterious style that was a minority in the past, I would not be surprised that for the future this is the dominant one, right? With all the amount of social engineering you can do today and the way you have to analyze consumer sentiment analysis and what people like and people don't like, and you can even guess what people are going to buy. Then if you have smart LLM reading Reddit all day long, maybe this style is going to be the way of the future, isn't it? Right? So I'll just leave it there. It's a bit of a science fiction comment. And another one is something that was called technical analysis, and you may have heard this. There are people that believe that if the market has dropped, say 11%, they broke 10% from the previous high. They broke their resistance level of 10%. So it's going to drop another 3, another 4%. There are people that have come up with rules like that based on some magic numbers seem to explain the behavior of certain stocks, conditional on certain triggers. Okay, now that's been there for a while. Again, not a style that was very well accepted by the by the investment participants. But now, some of those things are turning into a type of neural networks that maybe there's something to them. So these are two styles where I believe technology is going to alter fundamentally. I'm not going to talk about them here. I have 2 comments about science fiction, but I'm not going to do science fiction for you today. Remember, I want to focus on the philosophy of why we do what we do, right? So why would I spend time telling you about neural networks? That's not, it will not be an efficient use of 3 hours of your time. Okay, so I want to focus on the philosophy. Because of that, these styles are not going to be discussed today, but everything I will say today, if there is a change and they become predominant and they happen to involve you in one way, you will be well prepared to position yourselves to take advantage of it. Okay? All right, so how does a fundamental equity trader look at the world? They would look at the world like that. They say, oh, I pick technology companies, I don't know for what reason. They would never pick technology companies to do a fundamental trade, but I guess I wanted to entertain myself. So these are my technology companies that I want to look at. How do these companies look like to me? Do I want to invest in Apple, Microsoft, Verizon, HP, or Google? How do I decide which ones of these companies I want to buy from a fundamental trading perspective? So they would look at numbers, and I have some of those numbers there. One of them is price to book. We already came up with the concept of price to book when we looked at the Merton model, remember? So the book value was what? The book value is the difference between your assets and your liabilities, right? So if the book value of the company is, I'm making this up, is $5 per share, and the company is trading at $50, that's not expensive, no? You're paying, what, 10 times price to book? What's the average? It's about 7 or something like that, right? So it changes through time. But imagine that the price to book of a company, so say the book value of a company is $5 per share and the company trades at $5,000. That's definitely expensive. Why would you pay $5,000? But then, wait, Facebook, when they did the IPO, what was the book value of the company? What assets did they have? They had a website. Worth how much? And an algorithm. I don't know, right? Sometimes these things don't work. So then you look at other things like earnings per share. Earning is your cash flows, your free cash flows. Net income, your free cash flows, your EBITDA, earnings before income tax and depreciation of assets. These are accounting terms that you have seen. So you make accounting-driven decisions. And that's how you analyze these companies. For example, here I have the PE ratio for Apple is 17 versus Microsoft, which is 30. Which one is a better company from a PE ratio perspective? Apple. Microsoft seems expensive from a PE ratio perspective. Which is the best company from a PE ratio perspective? HP. Is the cheapest, right? So if you are a type of a fundamental trader, you say, you know what? I buy HP, thank you very much. It's only 12 times. Now you're a growth manager. Oh, HP? Why would you buy HP? Price to book, price to book. Understand? That's how they think and that's how they act. But you can look at many things. Price to sales ratio. For some companies, that's what matters. And here there's an art and a science. The science is you look at these numbers. And the art is you need to know which number is relevant for what company. Because for some companies, these numbers just look terrible. The company could be very good or vice versa, right? You can come up with many different accounting formulas, and you're not going to follow them blindly. That's why investing in this style is not, it's still today is a bit of an art, and that's why still so many people, they listen to whatever Warren Buffett has to say. Because the perspective that he has. Now, when it comes to a growth trading, things are slightly different. You look at other metrics. You look at, for example, historical growth strength. It's a derivative. You don't look at numbers. If you want to think of growth, you look at derivatives. And you want to know how this how historical growth has happened. These are some very simple triggers, and I'm just going to give them to you. No particular commentary on them. For big companies, if your historical growth has been 5% per year, that's pretty good. Okay, then people say, well, if you've been growing at 5% for the last 5 years, that means that you're going to continue to grow. You have to extrapolate this somehow. If you're a small company, that number is higher. You have the trigger is at 12%. That's one perspective that they take. But other things too. Strong forward earnings growth. So analysts, they look at companies and they make predictions for how forward earnings are going to evolve. How do they do that? Well, they have to make scenarios and they have to analyze what's going to happen in the future, and that's how they can get to that, right? And then if the earnings growth is going to be at the rate of 10% per year, that's pretty good. And then say, well, that's a growth there. You want to get into that. Then you get other things that, again, have an impact on the future. Efficiency, costs, revenue. And all of this could come together as an example that I'm going to do very quickly for you here. The case of Microsoft in 2003. The historical growth of Microsoft has been in excess of 10%. That's in excess of the 5%, which is the standard. That's good. So it looks good from that perspective. From a projected earnings growth, it also looks pretty good. 11%. Then from a cost and revenue control, revenue control is coming down. So I have here the pre-tax margin on the most recent fiscal year is 45%. Fantastic number. The 5-year average fiscal pre-tax margin is 50%. And the industry average is 26, so it's twice the industry average. So these are things that look into the future and allow you to make predictions. And and the projected return on equity is projected to be also in excess of the competition. So this is what would go into the consideration of Microsoft as a growth rate in the year 2003. Very different from fundamental, but also based on accounting. It's just that there are projections on the accounting numbers for the future. For the first time in this course, I need to explain to you in great detail how shorting stocks work. We've shorted stocks a lot already, we've seen that. But today I need to be very realistic about how shorting stocks actually works, because that's going to be very important in the risks that shorting has. And today it's all about turning risk into return. So the process where you short stock is not as simple as to just buy a negative units of stock. In fact, some of you may already have shorted stocks through your broker, but I want you to understand what happens behind the scenes, because it's very relevant to understand how this type of trading works. The first thing is, when you short a stock, you have to borrow it from someone. There's an actual physical borrow. You don't see that. That is done through the broker. And you need to have a willing shareholder that will lend you the stock. And then you buy the stock, you sell the stock, you get it, you sell it, you get cash. That's where you short sell it. You get you pay a negative amount of money, which is you collect cash. And then you pick up a liability. You have to return the stock to the owner whenever you want, or whenever the owner wants. Who has priority? Let's say that you borrowed the stock, you sold it, and now the owner says, I want it back. What happens? Wait, I borrowed. No, don't bother me. No, I'll return it to you. That's who has priority. The owner has priority. You have to return it. Right? When would they want it? Typically when it's expensive, right? If it's cheap, why would they want it? So what happens? This is a risk which is it rests entirely on the shorting process. If the owner of the stock wants to sell it, typically linked to the stock being expensive, you have to return it. So your short is going to not work. And waiting is not an option. You have to return it. Of course. You oftentimes do this deal through a broker, and if the original lender wants the stock back, the broker typically has lots of other stock available, and you don't even notice. They just swap them because the stocks, they're all indistinguishable. They all have a number which they keep in their database, but you don't care, they don't care, no one cares. You just get a different stock, right? So you don't notice that until enough owners want the stock back, and then they can run out. And sometimes that happens, they run out. It's called a short squeeze. And we're going to see an example of that, one that happened, okay? When you short the stock, you have to pay financing fees for that. And today I'm going to take them into account because they will affect the functioning of the financial system. Not only I'm talking about hedge funds today I'll be talking about banks and how banks make money. And goes back to my previous comment that hedge funds are really everywhere. And we're going to see how the banking business is affected by hedge funds in one of the examples that's going to come up. Okay, so for the lending to happen, there has to be a process which happens before the lending, and it's called the locate process. And this is one of the reasons why, if you want to do shorts, you want to do shorts with a very big broker because they have bigger inventory than a small broker. When you buy stock, it doesn't matter much. If you shorten stock, you need to have a good broker. And not only because of their ability to find stocks for you, it's also the funding part. Because I'm saying here a financial rate, and I wrote Fed plus a spread. That's a Fed funds, whatever they are, 3%, plus a spread. The spread could be 30 basis points, it could be 100%. Not all stocks have the same rate. And this is something you have to factor into your calculation. We'll see examples of that today. So all of these things are important. Now, to make it more interesting, let me talk about another thing called the uptick rule. When shorting was regulated for the first time, and that was after the Investors Advisors Act of 1933, like most of the rules that still govern today's markets, 33 or 34, or two years there. There was a restriction. When you short the stock, you borrow it, right? But you could not sell it immediately for cash. You had to wait for the stock price, tick by tick, to go up one tick. That was done as a safety mechanism to prevent the massive short selling of stock. Because if you do massive short sales of a stock, the stock just keeps on going down. You borrow more, you sell more, and then you can bankrupt a company. So no, you have to wait until someone comes in and says, no, I want to buy stock, and then you can continue to short. This was phased out in the United States in the year 2008, but I believe it's still there in Japan, for example. So in different jurisdictions, they have different rules. And these are rules that either you have to know or your broker has to know, but they could also affect the way you do your trade. You may think that a tick is not relevant. Well, sometimes it is. Because in some of these big momentum trades, if you want to do a momentum trade on the short side, this prevents you from getting into a momentum trade. Well, no, it doesn't prevent it. It just makes it more challenging. You have to wait for your entry point, right? This is good. You have to wait until it goes up, and then maybe you lose a few dollars when. Yeah. Okay. And I already went through the short squeeze. Well, mathematically, short selling stocks corresponds to just buying, negative amount of stock. I want you to understand that there's a process behind it that makes the short selling very tricky. So we went through that. I'm just going to, it's a review of what we already saw. So let me go to the example that I explains everything best. It's the short squeeze of Volkswagen in the year 2008. I don't know how much of this you know, but this is an extremely interesting case. If there is ever the Volkswagen short squeeze, the movie, go watch it. Okay, there's really a lot going on here. It all started around the year 1920 or something like that, and it all started with a person by the name Ferdinand Porsche. Porsche, it's a German guy, Ferdinand Porsche. His name is oftentimes mispronounced in North America, and people call it Porsche. Porsche. I don't speak German, but I know it's Porsche. This guy had a very good business, some of which we know and some of which we suspect. What we know is that he started doing agricultural equipment, tractors and this and that, and then trucks, and they got into the automobile division. I suspect he also did tanks, but I don't know. And when Hitler went into power, he said, "Oh, this is very good. I will buy your automobile division from you, and it's not going to be called Porsche anymore. It's going to be called Volkswagen." Volkswagen, which in German means the car of the people. And legend says that Ferdinand Porsche made his entire family swear on his deathbed that no one will stand still until they got Volkswagen back into the family. Understand? That's where the movie starts, you know? All right. 2008, I don't know, your babies, I don't know how much of this you know, but 2008 was a terrible year for financial markets because everything was bad. The subprime crisis had started to explode in 2007. 2008 was in full swing. It was a mess. Financial markets were, you didn't know which one was the next bank to blow up, right? And in particular, one of the industries that was hard hit by that was the automobile industry. We already went through Goodrich in 1982, a couple of weeks ago. This was worse. Interest rates were not high. That was the saving grace for 2008. But everybody was short automakers. As you probably know, GM went bankrupt in 2008, remember? You know? GM for decades was said to be the company that will never go bankrupt in the United States. Well, went bankrupt in 2008. Everybody was short cars. I don't know if I told you, there's a very interesting story in 2008 dealing with Volvo and Renault. Renault is the French car maker. In 2008, they owned Volvo. And, but of course, Volvo was perceived by investors to be a Swedish company. Well, it was a Swedish company, but owned by a French company. And it didn't go as much as Renault. In fact, you could buy the whole company, Renault, was very cheap, pay all the liabilities, sell off Volvo and make money. That would have been a very big trade, but that would be an arbitrage trade. But everybody was short cars. And I suspect, I don't know what they were thinking, but I suspect Porsche saw the opportunity to take over Volkswagen at that time. And this is what happened. On Friday, October 24th, 2008, this was the shareholder structure of Volkswagen. Porsche owned 42.6%. The state of Lower Saxony owned 20.1%. There were shorts. 13% of the stock was out on loan, which leaves what's called a float of about 25%, just under 25%. The float is a very important number to look at, sometimes called the open interest is the 25%. When you're doing a short, you need to know how much stock is still available for trade and what the daily volume is. Once those things start to get close to each other, you're at risk, right? So people watch that. Every short seller watches that. Now, I've read that in the case of GameStop, Balkan Capital did shorts for more than the volume or more. I cannot believe that. I mean, maybe they did it, but I have to tell you, short sellers, you never get anywhere close to the daily volume for the open interest because it's very risky, as we're about to find out. Here it was very far. Still 25%. That's a very big number, right? Volkswagen does not trade 25% of its stock on a given day. But this is what happened. On Sunday, October 26th, in fact, I was part of this short. I got a call on that day, one of our managers on Sunday said, well, look what just happened. The CIO of Porsche announced that they had cash settled options on Volkswagen stock amounting to 31.5 of the company, 31.5% of the company. If you get a call on a Sunday, you're short. You're short Volkswagen, right? I want you to understand this. And then you get a call that Porsche has bought 31.5% of the stock through options. You're not sure when they matured, you just don't know. What happens? You freak out. Why?
So the price is going to go up. The shares.
Yeah. Why?
Because you're short, so you're gonna.
The thing is that there are not enough shares. There are not enough shares, right? There are not enough shares. Look at that. That's more than 100%. So on Friday, you went into the weekend happy, thinking that you had 25% buffer. But now, when the CIO makes that statement, say, wait, what? Everybody sees that? You don't know when these options are going to be exercised. You don't know. But even worse, you're not the only one who's scared, right? 13% of the stocks are out on loan. So what's going to happen in Frankfurt at 9 a.m.? Frankfurt opens at 9 a.m. What's going to happen in Frankfurt at 9 a.m.? We discussed the other day what time you go to work, right? Well, this day you go to work on Sunday. If you're short, you have to buy shares from call all your friends. Do you have any shares? Imagine they say, yes, I have some shares. What do you do? Marketing is not open yet, okay? You have to do an over-the-counter deal. What do you do? Buy them, right?
Pay a premium.
How much you pay? How much are you prepared to pay? In addition to the price, of course, you can say, well, they trade at $50. I'll pay you $50. How much are you willing to pay? Yeah, I don't care if you know the right answer, but I want you to understand the situation. Today's going to be a lot of situational discussions, a lot of them. This is the first. What do you do? How much do you pay?
You would pay more than you should.
Absolutely. How much more? Let's say we do a trade, you and I, okay? They trade at 50. I say, give me 100.
I'll do 100.
You'll do 100?
I'll do 100.
Okay. Why do you do 100?
In case other shorters would do.
Because they may say, this is going to go up by how much? There's no limit to how much money you can lose, right? And you don't know. You may do some calculations. Oh my God, 15%, damn, So let's see what happened. So, of course, on Monday, October 27th, Volkswagen opened on the rise. Of course, everyone was there to buy stock, right? Then you're the owner. I said, oh my God, in 2008, a stock is going up in my portfolio. You may not even know about Porsche. But I said, all my stocks, it's all red, but this one, look at that. Where's this going up? What do you do? You're now the owner. You're a different situation, right? You're the owner. You sell. See, finally, my prayers were listened. I can finally sell something. You sell. But guess what? What happens when you sell? Someone gets triggered, right? You see that? And then someone who didn't want to do the deal with you said, oh, then you got a call from the broker, said, sorry, sir, sorry, ma'am. You got to sell. There are no more shares. I ran out of them. Sure, you got to buy. That's the problem. You got to buy. I said, can you wait until tomorrow? No. You got to do it now. Everybody understands this? This is called a short squeeze. And it's very unpleasant. It's very unpleasant. And then you're the short seller. You need to buy it. When you buy it, what happens? It goes further up. So someone else is going to get called. Understand? Okay, that's it. The stock went up to at the top, almost 300%. So you would have been, okay. You only lost 200%. Some people lost 286%. Right? And where's this risk coming from? This is not a risk we have seen before. It's a completely operational risk, dealing with the way markets work, right? All right. This is actually so interesting that I teach in Germany, and it's a different class from this one. It's very practical. The students have to collect data from the DAX index, which is the German index, and I have to tell them for the analysis that we do in class, I have to remove the Volkswagen stock from the sample because it destroys all the statistics you want to do that one day. Still today, it destroys all the statistics. Such big. All right. So, but there are people who that's all they do. They do short sales all day long. There is, for example, this company in New York, a hedge fund, technically, I guess, that what they do is 3 lawyers. They go to work, and they do what you may consider they do what you may consider to be the most boring job on earth, which is just go through SEC filings. You know what a Securities and Exchange Commission? This is the Securities and Exchange Commission just saying things that are potentially damaging to companies. So, okay, here's another one. Here's another one. And they see something. Whoa, this looks bad. I'm going to short that stock, and then they continue reading. That's what they do. That's perhaps not the type of vision you have for a hedge fund, but that's what they do. They just look for dirt all day long. They don't care about good companies. No, that's for someone else. They just look for dirt and then they short. You gotta be fast, right? You need to read very fast. Who's the faster reader today? LLMs. Take your pick, right? If you can train your LLM to read all these SEC filings the minute they're published, then you have an edge, right? Yes? Okay. You understand what I'm talking about, right? Okay, good. Now, it's very risky. Even these guys, they're going to short this stock because this, bad stuff. And then guess what? There's a big drug company. They don't care about the SEC filing. They just buy the company. They want to buy it very quickly, and they pay twice. And then what? In trouble. Right? So these things could happen, but there are people who specialize in that. They're called short selling gurus. That's all. Okay, they do. Now, when you now put longs and shorts together, we have a very interesting phenomenon which is new. We haven't seen it before, and I want to describe it with an example. This is an example of an equity long short portfolio. This is something that looks something like this is quite real. This is a pretty good analog to some of my equity long short portfolios when I was doing this. Some of the companies don't exist anymore, but it doesn't matter. I guess when we look at this, what I have is you have the ticker symbol on the left, and these are the companies that are on your portfolio. Then you have the number of shares, and the next field says whether you're long or short. So in this case, we can see there's 3 shorts. I made it simple, so most of them are long, but there's 3 shorts. So I'm long Apple, I'm long Bank of America, I'm long Citibank, I'm long the Dell Corporation, but then I have 3 shorts. You see the shorts? Well, let me talk about the shorts for a little bit. My longs are fine. My first short is a Google short, and that's what's called a single name short. Single name short. As a difference from my index short. Here I'm short the S&P 500, all of it. You can see the S&P 500 because the SPY ticker symbol is the ticker symbol for the S&P 500 ETF. ETF. What's an ETF? It's an exchange-traded fund. You cannot buy and sell the index. The index is just a mathematical construct. The ETF tracks the index that you can buy and sell. Okay? So mathematically they may be the same, but practically they are very different. So you're short the SPY. Now, I want to draw your attention that from a size perspective, this Google short is about only 10% of the size of your typical trade, right? Much, much smaller in size. Why is that? Why? Because you're prudent. right? Even a company like Google could go up by a lot on a given day. And this was many years ago. It was not as big as it is now, right? We don't want to be short squeezed or something like that. The risk profile of every short is always higher than the risk profile of any long. So if the risk profile is higher, you're going to invest less. That's the basic principle. If there's one thing you need to learn at APM466 of today is that if something has a lot of risk, you don't put a lot of money into it. Yes? And that shows there. But now, what about the S&P 500? How come that's my biggest number in magnitude? It's about 10 times as big as my typical long. Why? I don't care. Because the S&P 500 is not going to be taken over by anybody, right? It is a good description of what all the stocks do, and I have a lot of stocks there. I have about $14 million. I have about $14 million worth of stocks on the long side. So it gives me a very good hedge. Yes? And the S&P 500, I don't care. I don't have a problem with the short squeeze or operational shorts or anything like that. That's the difference. And how about that third short? Anybody knows what that is?
It's the NASDAQ.
It's the NASDAQ index. It's the NASDAQ ETF. It's the ETF for the NASDAQ index. Because the portfolio manager says, yes, I have a lot of exposures to the markets, but the technology sector is always a little bit different. It's a bit more volatile on the upside, on the downside. So if you want to have a slightly more precise, accurate hedge, then you're going to have a short not only on the whole market, but also, and this is the result of a calculation, on your technology components identified by the NASDAQ index, right? And I have this portfolio with some longs, some shorts. I'm going to just, let's say that it's about $15 million on the long side and about $15 million on the short side. You got it? Yes? Believe me, it's about that, right? Good. So it works like that. It's a pretty good portfolio in the sense that whether markets are going up or down today, I don't know, I don't care. It doesn't affect me whether the market goes up or down today. What affects me is that Apple does better than the NASDAQ. That is what affects me. So if Apple, comparatively to the other stocks, or Dell, comparatively to the other stocks, does good, then that's what I'm aiming for, right? That's what this portfolio is put together. But now let me ask you a question. How much money do you need to support this portfolio? I'll give you three possible answers. They are all extreme. This says 15 on the long side, 15 on the short side. So one possible answer is that you need no money. Right? No money. The shorts give you 15 million, you take that and you buy the longs. Untouched. You need no money. That's one answer. Another answer is you need 15 plus 15, 30 million. Right? I don't know why, but that's an answer. And another one will be, somewhere in the middle, 15. So let me do a show of hands. You're not supposed to know the answer. I'm going to give you the answer, but I want to know your reaction to this before you see what I tell you. So who would vote for the answer that you need no money for this? Okay, who would vote for the answer that you need $30 million for this? And who would vote for the intermediate answer that with about 15 you're okay? Okay, all right, good. Okay, so what I'm going to do, I want you to understand this because this is also beautiful, but very useful. This is the type of thinking that we haven't seen yet, and I want you to understand it. So for that, I'm going to do a very simple case, very simple example of only two stocks, A and B. I don't know if they are single name shorts or longs or indices, doesn't matter. They are both valued at 100. A is the one I like for whatever reason, value, growth, momentum, doesn't matter. And B is the one that I think is worse than B for whatever reason, doesn't matter. And I want to create a portfolio of 9 A's 9 Bs and I have $1,000. That's going to be my working example. I understand? Same question as what I asked you earlier, but instead of having 30 stocks, I have only two, one long, one short. $1,000, $100 each, 9 of each, long and short. Yes? So what happens when I do that? I don't care how I came up with this discussion. That's not what we're discussing now. This is how much money we need to do that. So let's say, just to put things into an even more practical perspective, that I'm right. After a year, A goes up by 10% and B goes up by 5%. And when I say I'm right, why do I say I'm right? Because my thesis was that A is better than B. I'm right. So this is supposed to make me money. I'll probably lose money if I'm wrong. Being wrong is what? That A goes down by 5% and B goes down by 10%? No, I'm still right. I'll be wrong if A goes down by 10 and B goes down only by 5. Then I'm wrong. I'm also wrong if B goes up by 10 and A goes up by 5. Because my thesis is that A is better than B. Right? But I picked this, only one scenario, and I want you to understand what happens in this particular case. And I'm going to look at 3 possible trades. I'm going to start with a conservative trade, which is one in which I have $1,000, and I'm going to go long 9 A's and short 9 B's. Okay, I'll call it conservative. You can say, oh, conservative should be that I need $1,800. Same, doesn't matter, same thing. So, of the $1,000, I use $900 to buy A. And after a year, A will be worth $990 because it goes up by 10%. I want you to follow the numbers, please, okay? If you don't follow the numbers, you don't know what I'm talking about. You will not about the philosophy that I'm talking about. The shorting of B will give me $900 in cash. That's where some of you think that I can do this with no money. But this is my conservative trade. I want to have $1,000 in my pocket just in case. I'm not sure why yet. And then at the end of the year, B will cost me $945. Now, I'm going to pay a fee for this. Remember, this fee is going to be very important in our discussion. I'm going to pay a fee. I said it was Fed plus some. I want to say it's 1%. 1%. A very simple number. So I pay $9 fee for shorting B. And the result is that after a year, I have made $36, which gives me a performance of 3.6%. Is that clear? You follow the numbers? 3.6%. Okay, before I continue, let me pause and ask you another question related to everything we've done for a week and a half now. How do you feel about that 3.6%? Good or bad? Don't answer. What did the market do? With the information you have, what did the market do? A went up by 10%, B went up by 5%. I'm going to guess the market went up by 7.5%, right? Market went up by 7.5%. I go up by 3.6%. Do I get a bonus or not? Am I good or bad? What is this? Bad?
Very bad.
Why? Because the market went up and I went. Because the market went up by 7.5 and I went up by 3.6. Okay, what if the market went down? By 10%. By 7.5%. But I'm still right, which means A went down 5%, B went down 10%. How much money do I make? The same. The same, right? So the market goes down, I make 3%. Do you like that? No, you do, but what changed? What changed? This is a very important question. We already saw, I think last week, that when you look at performance, it always needs to be linked to the risk that you take. And the risks that I take in my portfolio here are very different from the market. So to compare this portfolio to the market is futile. You can't. because they consume completely different risks. Let that be the first thing we learn from this example. When you compare investments, you have to look at the risk that you took before you compare the returns. Never compare returns without knowing if the risks are related, because you're never going to have the right answer. Never. Okay? So the thing is, I don't know. If you ask me if this portfolio is better or worse than the market, I would say I don't know, because they are different. Very, very different. But let me continue. We're going to understand this 100% from every possible direction. This trade we're going to understand 100%. And from here you'll understand very, very well how to do long, short trades. Okay? Now let me look at what I call an aggressive trade, which is I'm going to do this with only $500. I don't have enough to buy my A's, but I can short my B's, gives me $900. I buy my A's for $900, I still have $500 in my pocket. Right? I make how much? The same, $36. But of course, I only invested $500. So my return is now 7.2%, right? Now let me ask everybody again, what did the market do? Yes, pick up. What did the market do?
Increased by
7.5. And my portfolio increased by 7.2. It's pretty close. Which one is better?
The market.
You think the market is better? For me, there's no contention now. I did better than the market for sure. My risks is less than the market. And the way to understand that the risk is less than the market, I invite you to think about this in the following way, and we've already seen that. Go back to your assignment number 1. In assignment number 1, you calculated your eigenvalues and eigenvectors, remember? That gives you the risks of the market. These are the directions in which the markets move, right? In this trade, whether it's the conservative or the aggressive, what have I done? I've removed the first eigenvalue. Is that clear? The first eigenvalue is gone, right? So my risk is definitely lower than the market. No question about that. In both cases, my risk is lower than the market. How much lower, I don't know. But based on numbers that I know, it's about half of the risk of the market, because the first eigenvalue is about half. Are you following me? I'm doing linear algebra with you now, on the fly. So the risk is about half. So I would argue that my first example, the risk is half, my return is half, my Sharpe ratio is the same. And we saw the relevance of the Sharpe ratio last week. It's not the answer to everything. In fact, we're going to see many more things today, but it's a way of thinking. So from a Sharpe ratio perspective, my conservative trade is about the same. So I would say my portfolio is just as good as the index from a Sharpe ratio perspective. Are you following me? But this one is definitely better. My risk is half. My performance is the same. My Sharpe ratio is twice the market Sharpe ratio. So for sure, this is a better trade. Right? I don't know if you're following me. Any questions on this? This is an important, this is philosophy. That's why I didn't write it there. I would be afraid of writing this on my slides, because it's the way you think. The calculations I'm telling you, they don't measure anything. It's just philosophy. Using eigenvalues and eigenvectors to understand what I'm doing. Yes?
So do you mean like we can calculate the eigenvalues for our portfolio of this one, and then we're gonna return to.
You can calculate the eigenvalue for the market. For the market, right? And what is you calculate eigenvalues and eigenvectors for the market. And the first eigenvalue is going to be, or the first eigenvector is going to be what? Half A, half B. Right? What's my portfolio? Is +9 - 9. It's orthogonal to that. Right? So that's why my portfolio lives, from a spectral perspective, lives on the span of all the eigenvalues but the first one. And the first one contains a lot of risk. You got rid of it, right? Now you can go into the actual size of the eigenvectors and eigenvalues, and you can see that it's not only that the first one is the biggest, it's about half of the whole market, I'm telling you that. It showed up in one of my slides a while ago, but it's about half. So if it's about half, that means that the risk of this portfolio is about half of the risk of the market. I'm using eigenvalues and eigenvectors, but this is philosophy. You can't measure this. But if you're guided by this philosophy, you can have a pretty good engine to do very good analysis of what you're doing. Are you? Yes. So this example is very effective from that perspective, because with this, and your assignment number 1, I think you can understand that immense universe which is behind this example. Do you see that? Do you sense that? No? Okay, I don't know if you sense that. I'm hoping. I'm trying. Okay? Okay, let me continue. Let me go to what I call the impossible trade. The impossible trade is as follows. I'm just going to go, and as some of you said, I'm just going to do this with no money. Go to the bank. I said, let me short sell this, $900, great. Now I'm going to use this to buy A's, okay, and then that's it. After a year, I'm right. I make $36, which is an infinity % return because I put no money down, right? Now, why do I call this an impossible trade? Is this impossible or possible? So let me tell you about that. I want to tell you about that by telling you another story. I'm going to come back to this after I tell you another story. Have you heard of a firm called Long-Term Capital Management? Does it ring a bell? No. Robert Merton and Myron Scholes rings a bell? Yes, they were in our course. They got the Nobel Prize for economics in the year 1997. Both are brilliant people. Both are brilliant people. Myron Scholes I was closer to than Merton. Brilliant people. They had a hedge fund. Some people think they managed the hedge fund. They didn't manage the hedge fund. They were directors of the fund. And now you know the difference. The trader here was someone by the name John Merriweather. And I don't know how much of this you know, but this happened. So this was a hedge fund. And what they did is, if I use this as a metaphor, they were doing this impossible trade. It's a metaphor. They were not doing it. They were not doing stocks even. Okay, they were doing other things. But they had something. They went out, and there was John Merriweather. So he would find a bond, say a 29-year bond that was very cheap because someone wanted to sell it, and it was in the bond lingo called an off-the-run bond. Off-the-run bond means that they are there, you can buy them, but in very small amounts. No one really wants them. They're not the bonds that people buy and sell. So you buy them cheap. But then you finance them by short selling the bonds that everybody wants, which are more expensive. You can short sell liquid bonds, on the run bonds, and buy cheap off the run bonds. You understand that? And then you wait. One is a 29-year bond, the other one may be a 30-year bond. They don't exactly match. You understand that now? You did assignment number 1. So every 6 months you make a half a penny. But you just wait. And after 30 years, that half a penny becomes a substantial amount of money, and it costs you nothing, right? So what Jerry Merriweather did is, and again, it's an exaggeration, okay? Not at the level of fake news, but it's an exaggeration. So he went around to the banks and said, I'm going to do this deal with you. And it was 1996, something like that. The date is important. And then the bank will say, oh, that's great. So we'll do this deal, and then you put some money into the account, and then John would say, no, I'm not going to put any money in the account. So why do you do that? No, I don't need it. Look, I have that. And he convinced a few banks to do this for him. And why did the banks do this? I'm going to switch sides now. I'm not talking about hedge funds anymore. I'm talking about banks. Why would a bank allow you to do this? Why would a bank like this? $9. Look at that. That's how the banks make money. Did you think coming into this course that the banks make money by doing trades like this? No, they make money financing trades like this. That's what banks do. The bank revenue is the $9 in that spreadsheet. See that? And banks are very happy. Actually, banks are typically, let me tell you, banks are typically not happy with a conservative trade. Why? Because you need $1,000 for that. They only make $9 out of your 1,000 of capital. They're very happy with the aggressive trade. Why? Because based on the money you have with them is twice the income. They don't care for your revenue. They don't care for your profitability. They don't care whether the S&P 500 goes up or down. They want the $9. That's the bank business. And many of you will be in banks selling this to hedge funds. I told you, they may be your client. And then you need to know what they want from you. What do they want? They want that. So you, the bank, are happy with the impossible trade. Because then your volume goes up and your $9 gets multiplied by a very big multiplier. And the hedge fund is happy with that too. And the state of long-term capital management is that they had that and they had like $5 billion worth of that. And then 1998 came. And in 1998, and I don't know if we went through this already, but I think I did when I reviewed the history of risk management. What happened in 1998 is Clinton got impeached in Congress because of Monica Lewinsky, and Russia defaulted on their bond for the first time, right after Perestroika, right after Gorbachev. And credit markets straight up, and they got a margin call, as we're about to tell you later what a margin call is. And they had to unwind, and it was very, very, very bad. And the result of that is regulation called Basel II that we discussed 3 weeks ago, or something like that, or 4 weeks ago, that now makes this an impossible trade. In 1996, that was possible, but starting in 2000, 2001, this trade is impossible. Well, it's possible, but what happens is this. Now the bank, forget about the hedge fund, the bank has risk from doing this trade. Forget about the investors in the hedge fund. No one cares about the investors of the hedge fund because that's a self-regulated entity. Investors are happy to lose their money, let them. But the banks know. The banks are regulated. So the bank is going to have a calculation of their risk, like we saw how many weeks ago? And now the bank is going to have to post collateral against that trade. And then we're back in the situation of the trade that we did with you and someone else, where they say credit risk calculation. Remember the credit risk calculation? We saw credit risk calculations here. So the bank has to pay for that. So today, that risk is too high for the bank, and the $9 is not good enough for the bank. You understand this? So in this example, many of the lectures in this course come together, especially on the impossible trade table. Do you see how this overlaps with many of the things we have seen in this course? Just this. If you see that, then you've learned everything you're supposed to learn in this course. And if you don't, then you're missing something. I don't know what it is, but I want everybody to understand that this impossible trade touches on many of the things we have discussed here. Touches about the history of risk management and how Basel II was created. Touches on how credit risk calculations are done, as we spent 2 weeks doing that. Yes? Yeah, I don't know. Okay, let me continue. All right, we're gonna end this, and I need one more situational fact, and then we take a break. Okay, I can see that you need a break. I can see that, but I need to finish this because there's a little bit more coming, and this is very interesting. So because of that, banks now have a rule, and that's a rule that they need so that they don't have a risk that they have to pay for, and the $9 is still good. Right? And it's a rule like this. Long positions require a 50% collateral, and short positions require an 80% collateral. What does that mean? Let me show you. Let me go back to my trade, and I'm going to do what's called an initial margin calculation. And I have a portfolio. I want to buy 9 A's. So according to my calculation, that's going to require $450 worth of margin. And I'm going to short 9 B's. That's going to require $720 worth of margin, 80% of that, because shorts are more risky than long. So that means that I'm going to require a total of $1,100 and something, but I get $900 in cash when I do my short. That means that the bank is going to require me to have at least $270. We got it. For $270, the bank is happy because they make $9 and their risk is okay. What would my return be? My investors are going to be happy too, right? Because if I do this trade with $270, I have a return of 16.6%. It's pretty good. And I still have about half the risk of the S&P 500, right? The same calculation applies. Looks like a pretty good deal, right? See that? Everybody sees that calculation? What's wrong? What's wrong? What's wrong? Anything wrong? Okay, so if there's nothing wrong, let me give you to something that happened on October 13, 2007. August 13, 2007. Are you ready for that? This is what's going to happen, and we're going to reenact what happened on that very warm summer day of 2007. So half of you over there, you're very risk averse. You're the $1,000 people. You know, said, oh. And you guys are the risk takers. You're the $270 people. You get it? You see yourselves in that position? Risk takers? Sorry, risk takers and, risk averse investors, yes? All right. 2007. And you're all long A, you're all short B. 270 and $1,000. And I am Goldman Sachs. I also have A's and I also have B's. But I have like 1 billion A's and 1 billion B's. Yes? That was 2007. Investors were very, very nervous. And my investors told me they want their money by the end of September. I had to liquidate billions of A's and B's. Right? What do I do? How do you liquidate billions? Very hard. You can't just give an order because the market tanks. We have to do it carefully, right? So I pick a day which is okay in the market, nothing bad is happening. Investors may be, manager may even be, on vacation or sleepy or something. I don't know. Maybe they show up to work late, something. And I start dumping A's and buying B's because I need to liquidate my positions. That's what my investors are telling me to do. Yeah, are you following me? Are you following my story? What happens when I do that? I'm selling A's, I'm buying B's. What happens to A and B? A goes down, B goes up, right? So you guys, now, in addition to the margin that I told you, there's something else called variation margin, which is as you start losing money, you have to put up more margin. So the bank says, oh, your variation margin is something and you don't have enough. So you get a margin call. They call you, margin call. You need to put more money. How much more? Well, if you lost $5, you put $5. How do you put $5? How do you put $5? Don't reach into your pocket. It doesn't work. That has to be money from the fund. You don't have it. You have to sell A's, right? You have to sell A's. And by the way, you have to cover B's too, because then your portfolio is all screwed up, right? I understand that? That's a margin call. That means you have to liquidate your portfolio. You're screwed. Your business is finished. What happens to you guys? The conservative, very risk-averse investors. What happened? Well, you're very curious, right? No one is calling you. You have plenty of collateral, right? No one is calling you. You call people. You say, well, what's going on? What's happening here? You call me, the bank. Say, what's happening? And I tell you, sorry, I can't talk to you. I'm very busy doing margin calls. You following the story? And then you say, I got it. And you guys say, oh, I'm sure that these people that took the same class at Columbia with me, right? Because you're all doing the same A and B trade. Why? Because you're going to the same school. You think the same, right? Say, I bet those risky people are in trouble. And you call them and they see them crying, right? Yeah, you understand? Are you following this? That happened. Actually, this happened in August 2007, right? So this not only touches on what happened to long-term capital management, it touches on what happens in the subprime crisis. So this is a very interesting situation, which is that doing a trade for $270 does not seem like a very good deal because there's another risk we have never seen before, which is the risk of a margin call. It's not related to the markets, it's just related to your operations with your broker, right? So I have here an example of what I just told you. What I told you is more colorful and it makes a relationship with something that actually happened in 2007. And you, in this case, my example, you're $50 short. And what do? You don't have it. You need to liquidate your portfolio and then you're in trouble. Now, can I ask you a question? And this is a question about probability. In this situation, do you know how to calculate the probability that you get a margin call? Clearly, if you're at $270, the probability you get a margin call must be very, very high. A single movement in the wrong direction and then you're done, right? And clearly, if you have $1,000 extra collateral, the probability is probably very, very small. Do you know how to do that? Do you know how to calculate the probability you get a margin call? Of all people on earth, you should be the ones able to do that. Because you've seen probability and stochastic processes and time series and this and that, right? Are you able to? Well, yes, you are. At least this is going to make contact with something else we learned in this course in a different lecture, forgot when, like a month and a half ago. We already saw that. So let me make the connection between this example and something else we learned here. And then, so we don't want to do that. It's about your margin call. So this is how we think. Let's calculate together the probability of a margin call and then we take a break. So if I have an excess initial margin equal to a number A, I'm going to assume my portfolio is Gaussian as usual. That's how you always start, right? If I have a certain mean and a certain standard deviation to my portfolio, when will I get a margin call? I'll get a margin call when the maximum loss I have is bigger than A, right? That's when I get a margin call. The probability of not getting a margin call is what's written here. Is the probability that the maximum loss before A, that's when I don't get a margin call. But if my portfolio is Gaussian, actually better yet, if my portfolio follows an Ito process, what I'm looking at here is the maximum value of Brownian motion, which we saw. It was called a heating time. We saw it a few weeks ago, yet in a different lecture. And I gave you the formula at that time. It was part of a probability exercise. We used the reflection principle to calculate that. You may remember that, right? I gave you a picture of two graphs. One was black, one was red. Well, that actually is how you do this. And I have the formula there. I'm less interested in the formula than I'm interested in the fact that this is a consequence of the heating time calculation we did a few weeks ago. So this example touches on how many lectures we've seen here? Many, right? Good. That's what I wanted you to realize. So I'm reaching the end of this course, and I want you to start to realize how all these things, they are related to each other. And this course has been put together with that purpose, as I told you, right? We do this, we do that, and then something, it all is blended together. 10-minute break, okay? We've seen a lot of I hope, interesting facts about stocks, the world of stocks, and what kind of considerations they give rise to. I'm going to move now to another type of trading style, which is going to be convertible arbitrage. Not that it's particularly interesting in itself. Again, today is a class of philosophy more than anything else. And convertible arbitrage is a type of strategy that focuses on the trading of convertible bonds. Convertible bonds, I will tell you what they are. We already went through this, I think on the very first day of class. Again, today I'm trying to make connection with everything we've learned in this course. And I told you that if a company, for example, needs money, they can resort to a variety of different ways of financing, and we went through three. One is you try to borrow money, issue bonds, get indebted, get someone else's money. And if that fails, then you try to issue stock. And if that fails, one thing that you can do is you can do something very interesting, which is you take, it's all about getting the investors involved. So you're going to do something which is the worst deal for you, but it's the best deal for the investors. They didn't want bonds, didn't want stocks. So you're going to offer them the best thing that bonds have, which is safety, and the best thing that stocks have, which is upside. And the result is a new security, it's a convertible bond, that gives the holder of the convertible bond, on the one hand, the security of a bond is a bond, and that means in case of default, they have access to the assets of the company, but also gives the upside, and that is if your company does well, the holders of the bond can switch the bond into stock, so they get the upside. They can become shareholders. This is an option. In fact, if we go back to the 33-cent game, for example, we can easily restate the 33-cent game so it's a convertible bond. The convertible bond will have a payout. If the stock goes up to $2, then you get $2. You convert your bond into stock. And if the stock goes to 50 cents, you get $1 because you have a bond. So that will be the exercise where if the stock goes up, I give you $2, and if the stock goes down, I give you $1. How much is that worth? And the answer is $1.33, because that's the example that we saw. That's a convertible bond, and convertible bonds are good for companies because that's how they get financing, but they're good for investors because they provide a different type of return and an access to a different type of risk profile, and it's all about risk. The thing is that these convertible bonds are typically issued by companies that have a very high volatility profile. That's why they issue convertible bonds to begin with, right? If Apple needs financing, they don't need to issue a convertible bond. Everybody will be very happy to buy their bonds, and if not, their equity, right? These are companies that they failed at issuing bonds and failed at issuing equity. So there must be some sort of trouble. And because there is some sort of trouble, we know that the risk is going to come from the company itself. So we're going to have to take care of that risk somehow. And hedging the underlying stock is the typical way of managing that risk. I'm going to show you how this is done and what are the perspectives and how to even do the sizing of those particular deals. And I'm going to do that with an example. I have a company here that has a convertible bond that sells for $80, 80. That's a $100 notional bond, so it's already sold at a 20% discount. That's pretty big. If you look at the prices of the credit spreads for bonds that we saw 2 weeks ago, that is like worse than B, right? It's not investment grade. It's pretty low. And you can convert this bond for shares anytime. Stock price is 10, and the convertibility is 10 times. So you can convert one bond for 10 shares. To make the case a bit more realistic, I'm going to assume that there's a coupon payment of $4 for the bond, and interest rates are at 4%. Okay? You get the picture? A company that could potentially be wonderful, but you're not sure. and they allow you to buy a bond for $80, and you can convert the bond into stock for 10. You like it? You like it? Well, we'll see. This is the trade I'm going to do. I'm going to do two things. I'm going to tell you the portfolio I do and what will happen if nothing happens to the stock. So a year later, everything is the same. So I'm going to buy the bond, $80, but I'm going to short the stock for safety. And I'm going to do something very extreme. I will explain to you why I do this very extreme trade. I'm going to short all 10 shares that I have the right to. All 10. Big. There's a reason why. Okay? And then when I short sell the 10 shares, I have $70 in cash. So what do I do with the $70 in cash? I buy T-bills, a very safe investment. So a year later, if nothing changes, everything is the same, my bond will continue to be worth $80. My shares will still be a $70 debit. The coupon payment will give me $4. The T-bill is going to grow by 4%, so it's 72.8. And I have to pay fees. I'm going to assume a 1% fee plus 4% interest rate. I pay $3.50 in fees to the bank. Right? Everything works. So I made $3.30. How good is that? We're investors now. We're not mathematicians. How good is that? No, not interesting. I'm making 4% essentially, which is the same I can make if I just buy T-bills and not have any risks. Right? So why did I do this? Well, I clearly did this not because I think nothing will change. I clearly did this because of a different type of scenario that I think is going to happen. Clearly not this, right? What would that be? Let me see what happens if the company goes bankrupt. I'm going to assume some recovery rate for the bond. I take $50, 50% recovery. It was the industry average. Remember that a few weeks ago? Right. But now if the stock goes to zero, my debit for the short sell goes to zero too. That's good. I made $70 there in my hedge, right? My coupon is nothing. My coupon is part of my recovery rate. The T-bill still gives me $72.80. I still pay my fees, and the result is that I made, well, a good chunk of money. I made essentially 50% return. That's why I did this trade, clearly, right? You see? In fact, let me tell you what I have done, and this is a different perspective on what I have done. What about if I told you that my real trade was not a convertible arbitrage trade. My real trade was a short position on the stock. And I used the convertible bond as a hedge. See that? I really wanted to short that stock. It's going nowhere. But it's very risky to short the stock. We saw that already. Microsoft likes it, buys them, pays twice the price, and then I'm screwed, right? If I do a short on the stock. But not if I do this. So this trade that looked like a convertible arbitrage trade was actually a short trade in disguise. Everybody sees that? It was a very smart short trade. And if the company goes, I don't make 100%. I'm trading risk for return. I make 50%. But look what happens if the company goes through explosive success. If I do a short on the stock and the company, I say, doubles, I lose 200%, right? Let me see how much I lose. The bond goes to 80 to, 100. I convert, so I have 10 shares, so it's 140. My coupon is nothing because I'm not a bond holder anymore. I convert it into stock. My T-bill still gives me 280. I pay my short selling fees, yes. And the result is that I lost 70 cents. It's not good. But if this really was a short trade, this beats any other short I can possibly do, right? Okay, so this is, I think you understand now where this could go, because I call the convertible arbitrage, and this happens all the time, but the numbers may tell a different story. So let me continue, because there's very much to learn from this example. Let me just give you, this is how you would do typically a trade. You come up with a lot of scenarios. I did here 2 scenarios on the downside for the bond goes down. I'm just going to go very quickly through this. This is all, you already know how to do that. The stock goes down and the bond goes down. Typically they go together, okay, down. And you got your coupon payment, you got your bill, you got your fees, and then, well, you make a bit of money. And typically, because this was a short in disguise, I tend to do better when the company does worse. Typically, right? Normally, it is the case that a convertible bond and the stock behave together. Not always. In the year 2005, I believe, GM had convertible bonds issued, and the bonds went down because rates went up, and the stock went up because a U.S. investor, Kekorian, just liked the stock and bought a lot of it. And then convertible bond buyers, they were convertible arbitrageurs, they got a double whammy. The bond went down, stock went up. It could happen. It's not normal, but it could happen, and it did happen with GM convertible bonds in 2005. Another story, right? But normally that's the behavior that we have. And if the stock does better, well, we think we're going to do worse because this was a short in disguise, but nothing very radical. We have all my numbers there, and I can see that sometimes I lose, sometimes I even make money. It depends on the balance between the two. But this, now that I'm finished, it could be a convertible arbitrage trade, but it could also be a short in disguise, and a very clever short because I'm protected under most other scenarios, right? Are you following that? It's clear. All right, great. Okay, perfect. So if this is clear, let me now leave this example and tell you how these things would be done in general. And what I want to do is I want you to think scenario wise. Like everything, we're going to have scenarios, things that might happen. And we want to understand what my portfolio would be under all possible scenarios. So if I have to do a trade like that, I have a company and there's a convertible bond, then I hire some graduate from APM466 or MAT1856. I have one of you guys, I say, okay, let me do this analysis for me, please. Give me a set of scenarios. You're going to work day and night for a week. You're going to look into all possible situations and this and that. I say, well, this is my conclusion. I have concluded that there's a 30% chance this company is being bought by Microsoft, and they're going to pay twice the value of the stock now. There's a 30% chance nothing will happen. The company will just stay the same. There's a 30% chance that the company is going to go bankrupt, under which I think we'll have a recovery rate of $30, 30 cents in a dollar. You see yourselves doing that analysis? Would you work for me if I hire you to do that? That's great, because now you give me that analysis, and then what do? Then I put my portfolio together. How do I put my portfolio together with your analysis? In fact, I'm not going to do it myself. I'm going to hire another one of you guys to put the portfolio together for me. Because what I'm going to ask you to do is to say, well, take this input of this, graduate from APM466, U of T, and then give me what the optimal trade should be. You should be able to do that. And for that, what I'm going to do, I'm going to show you how to do that. I'm going to come up with a parameter. This is a one variable equation. I'm going to buy the convertible bond. What I am unclear about is what the hedge should be. Shall I hedge all 10 stocks? Shall I hedge one stock? No hedge. What shall I do? So what you do is you do parametric accounting. I have three scenarios. I'm going to do a hedge consisting of X percent of 10 shares, where X is an hour between 0 and 1. And I want to see how much money I make and lose under each of the three scenarios given to me. So this is parametric accounting. You cannot do this in Excel, you can do this in Python. And with that, I can do parametric subratios. And I can see that as a function of X, that's the graph of my subratio. So what trade do you do? You buy the bond and you short 8 stocks. I give a phenomenal subratio, 2. You're done. Next deal. So you can trade convertibles now. Well, yes, you can, because you also know about short squeezes and how would you size this position? You have $1,000, how many of these trades would you do? Because here you also have a margin call, right? Well, you know how to do that too. Just look at what we did before the break. You see how it's all linked to each other? You see? You're going to calculate the probability that you get a margin call. Well, get the lecture notes from a few weeks ago and use the reflection principle to calculate the maximum of the distribution for the maximum of the Brownian motion. And then you got it. Then you know how to size this position too. You have the elements to do all of these things. That's why this class today is about philosophy. So you can see how everything you already learned works with each other to solve problems. Is that clear? Yeah. Are you with me? Yes. Do you feel powerful now? You should feel very powerful now. Boy, you feel like you'd go there and get, just work for any hedge fund and then just make a killing, yes? Well, you should feel like that. Or you can work for the bank too. You know how they work also. Right? Yeah, that's how you should feel. You should feel very powerful. You've learned lots of stuff, lots of good stuff. And I hope that comes together now. Okay, let me continue. Let me continue with this because I now have a story to tell you. And this is a wisdom that I can only tell you by telling you a story. This is part of the philosophy I want you to learn, but it's not about calculations of anything. It's just about wisdom. So let me tell you another story. 2008. I really recommend that you learn about 2008 as much as you can, because that's the year when so many interesting things happen and things that we'll never see again. Well, maybe. I'll summarize it for you. We've already talked about this. 2001, September 11, we saw last week rates went from 6% to 2% in less than a year. Opposite to what they did in 2022. That meant that money was cheap. So you could borrow money to do stuff. So mortgages blew up, everything got packaged into securities called collateralized debt obligations and similar things that made like risk was just gone and investors were not able to understand the risks hidden in a lot of these things. And then in 2007, there was a very rude awakening. 2 hedge funds of UBS blew up around the month of March. People said, what happened there? Wow. And then they realized that the structured credit market was in deep trouble. It was too late because these toxic securities were really everywhere. Iceland, Norway, everywhere, United States, Canada. Canada, not so many. There's a very interesting thing in Canada. I'll tell you something that TD did, TD Bank. TD Bank was the biggest credit player in the world, in London, which was the biggest credit player in London. And in 2006, I think it was Ed Clark, the CEO, asked someone to explain to him why something happened over a weekend. know, they lost like $200 million or something. So they explained all these things to him. I didn't get this from Ed Clark. I got this from other people at TD. Okay, I think it's true. And they said, I don't get it. So they tried to explain, and they went through this and that. I don't get it. So he said, we have 2 weeks to get rid of that. I said, my God, that's horrible. We're going to lose. I don't care. Just get rid of it. And they got rid of it. And when 2008 happened and the whole world blew up, TD was fine. In fact, it was so fine that they went into the US and they bought Ameritrade. And overnight, TD became the 3rd largest bank in New York City. Okay, so Canada was perhaps a little bit different. And I can talk about this for a long, long time. I was part of that. But everything was horrible because banks needed to be capitalized. And what they did is they went for what? Bonds. They issued bonds. Rates were about 2%. I know banks were issuing bonds at 25% annual yield, zero buyers. Then they issued stock. It worked at first. But then they had to issue so much stock, and stock kept plummeting that, well, they're not, numbers are not big enough for the number of shares they had to issue to capitalize themselves the right way. So they went to convertible bonds. Exactly what we learned here. This is exactly how the financial crisis unfolded. Everything got worse after the Lehman Brothers default, September 14, 2008. And so bad that the regulators had no solution. But on September 18, 2008, issue a very famous short selling ban on bank stocks. Now, you're all experienced convertible arbitrage traders now, right? What happens if you have money ready to go to buy convertible arbitrage bonds of banks, and now there's a short selling ban? What do? You walk out. You can't short. If you can't short, you're not going to get into those convertible bonds, right? See that? It was horrible. It was horrible. It was self-inflicted by the regulators. I hope some of you become regulators, the good ones. Okay? I have some of my former students as regulator. They are the good ones. You too, okay? Don't be afraid of a job on sales, regulation, things like that, where mathematicians are typically like, what's that? No, go. You'll be fine, okay? Take those jobs and call me. That's what you do. All right. So things got bad, and then in March of 2009, things were like really, really, really bad. This company, Citibank, its stock closed one day at 99 cents. Traded at 99 cents. If you had stayed at that level, they would be kicked out of the New York Stock Exchange. They don't take penny stocks. It's as bad as it was. So this happened in April 2009. Okay, Citibank had the Fed went out there rescuing banks. This is something you've heard probably about in the media about, the Fed rescuing banks, and many people misunderstand what that means. Some people think that the Fed was just giving money to banks. No, they were not giving money to anybody. They were buying things. And in particular, they bought this very famous convertible bond from Citibank that I want to explain to you because I was part of this trade. I know this very well. I want you to understand the wonders of this particular convertible arbitrage. So I want you to understand the world is about to come to an end. And the world was very close to having a very major breakdown. Okay? And then the Fed comes and they negotiate to buy a convertible bond from Citibank. I have some of the technicals here. You don't have to look. I'll tell you what's relevant there. The stock of Citibank was just trading at $1. At the time that in April, the stock was like at $3 or something like that. Okay? And they issue a convertible debt that the Fed is going to buy. That's a big signal to the investors, right? The Fed is going to buy it. Of course, the Fed could just be burning their money, but it's typically very dangerous to go against the government financially. And this is going to come up in the next story that I have for you. You typically don't go against the government. If the Fed goes into this bank, it's a bad idea to short the stock, because it seemed that the Fed was determined to save Citibank, right? So you don't do that deal. You don't short. But what do? You buy the bond? This stock was at $1 the previous month, and it was full of toxic stuff everywhere. What do? You can say, well, I leave this and I go and play ping pong. No, that's not an option. You are an investor. You invest. So you do what we've learned today. You buy the convertible bond and you short the stock, right? It hurts to short the stock at $3. It hurts. I forgot now, but I think this was a bond that matured like in around June or July. By July, the stock was like at 12. And this was what people thought. The stock is going to go to 12. I'm still going to short it at 3. I'm going to lose 400%. Go back to the tree we did earlier, remember? The stock is not going to go up by twice. It's going to go up by 4 times. Are you following the pain? So you buy the bond, the convertible bond, and you short the stock, and we made a lot of money. I mean, my investors made a lot of money on that trade. But who's the one who made the most amount of money? Who made the most amount of money in this trade? The Fed, because they didn't hedge. The Fed cannot hedge. If anybody knows that the Fed is going short the bank, I don't think they can even do that, right? But you understand what I'm talking about? This was a very, very profitable trade for them. It was profitable for us, and our short went from -3 to -12. But that's how the banking system recovered, through things like this. And the Fed had a very, very good balance sheet. They were making a lot of money, and they lost money on some deals, but they made a lot of money on some other deals. It was a very profitable trade. Do you understand that? Yes.
Was this after they lifted the shorting ban?
Yes. Well, it was, yes. There was a lot of back and forth with that short selling, but it was very dumb, very, very dumb. At least from my perspective. Look, who knows? Maybe there was something I did not know. But I was very deep into it. I was looking at for many, many months, I spent a good chunk of my time just watching into this and learning, so I could tell you at some point. Do you understand this? Fantastic, fascinating. But again, you are there. Everything we've talked about today, I can tell you now know more than most regulators about what happened in 2008 and 9. And these are the things that are very hard to learn. They're not in the books. We can't know this, right? I have the histories of convertibles here. You can read it. I'm just going to go ahead. Are you with me? Is this clear? You understand? You should feel very powerful today, okay? That's my objective. Let me tell you another, very quickly. This is a deal. It's a merger arbitrage event. It happened in 2001 in the dot-com bubble. That it was part of the burst, but there was an announced merger between Alcatel and Lucent Technologies. And when that is announced, what do? You go there and say, what's going on, right? And well, how can they merge? Look at that. Alcatel has a rating of A- and Lucent BBB-. You have no idea where the stocks are going to go. You don't know if this is expensive, not expensive. You don't know if there's going to be 2-for-1 shares. You don't know that. But you know that the credit rating will converge if they merge, right? So what do? What's the trade you do? You buy the cheap, you sell the expensive. What's the cheap? Lucent. What's the expensive? Alcatel. That's your trade. but be fast, because everybody's going to do that. And the minute you hear the deal is not going forward, sell quickly, because everybody's going to do that. You see that? That's it. You understand that, right? That's all I want to tell you. And this is an example of fixed income trading, fixed income arbitrage if you want, but in the context of a merger, sometimes also called event-driven. These are events which are like plus minus, they're digital events. It happens, it doesn't happen. If this happens, and it's very difficult to hedge. Well, I take a 50%. Can't. Right? Let me just go to, I want to go to the juicy example I have for you, which is, this, I wanted to explain how Air Canada was rescued by Cerberus, but I'm not going to do that. Instead, I want to tell you about another two trades, one of which I think you know very well, but I'm not sure. This is an example of something which is called relative value arbitrage. And the story is this very simple story, and this is a trade that happened. It lasted 2 months, and it has to do with the creation of the euro. On December 31st, 1998, the euro was going to become the currency for a whole bunch of countries in Europe. Great. So prior to that, the demand for euros was so high that the euro against the basket of currencies was trading at a premium. What happens when you see that and you're an investor? What do?
You buy all the baskets.
You buy the basket and you short the euro. And wait. Right? Then you go to do your New Year's Eve party, maybe you drink a little bit, I don't know. Then you go back and, okay, now you unwind the trade, right? And you make, according to this number, make almost 2% in 2 months for free. And by the way, what's the leverage you can do on that? You know how to trade your margin now, right? How much money do you need to make that 2%? Maybe you need 10 cents in the dollar. That means that the 10% is actually 20%. You're going to have a really, really good New Year's Eve party. Are you picturing that? When the clock strikes 12, you made 20% on whatever it is that you were doing. Yeah? You feel powerful? It's a matter of sizing. But we've seen sizing in the different context stocks, but it's the same. The math is the same, right? Okay, let me take you to another example. This is very famous, but very, very misunderstood by a lot of people. And it has to do with a style called global macro. Have you heard of this guy called George Soros? Everybody's talking about this guy these days. So let me tell you what happened. This is a very interesting trade. Very similar to the previous one, but in a different context. And I have some things written here, but what happened is very complex, and I want to do my best to tell you yet another story to this lot of stories. I don't know if you know the history of recent Europe. It started in the 80s. There was this desire to create a unified, maybe not a country, but certainly a monetary union. And for that, a number of countries, basically all countries got together, separated by initially Germany and France, and then everybody bought into that idea. And what they did was to create the European Currency Unit. The European Currency Unit, ECU, European Currency Unit, was a mathematical construct, was a theoretical currency. It didn't exist. It was a theoretical currency. And the countries that were going to be the members of the European Union were going to be participating in that. And there was the precursor to the euro. So the exchange rate was very similar to the one I showed you earlier. Okay, it's the continuation of the previous story, which you should not forget, because something similar happened here. George Soros did something similar to that, but big difference. Only one big difference. The key in this is, was Britain going to be part of that currency unit or not? That was the only unknown. Everything else was no. Was Britain going to be part of that, yes or no? The British were not very interested. They didn't want to be. The Germans wanted the British to be part of that. And I guess the French also, everybody, but especially the Germans. The Germans were particularly interested in that. And to do that, what did they do? Well, they gave the British pound an artificially high valuation within that basket as a way to entice Britain coming on board in the European currency unit. It was a political decision. Turns out that people, investors, they go to work very early. What do they do all day long? They do analysis, right? That's what you would do. You would do the analysis. This number is too high. The number is too high. You look at the GDP of the country, and this and that. This number is too high. It's too high by not an insignificant amount, maybe by 20%. Right? What do you do if you're an investor and a number is too high?
Make money.
How? You short it, right? So you short it. So can you picture yourselves being George Soros? You have a few $1 billion in your pocket, and you talk to your analysts. I'm sure he didn't do the trade himself. He had people like you doing the. He said, look, George. Look, 20% too high. You picture that? I said, what do I do? And you go home every day. It's 20% too high. Right? I said, well, I think we should short. Right? Is that the same as the short we saw earlier? The one that was going to be over in New Year's Eve party? No, because this was not an announced deal. You just do your calculation and you see there's a mismatch between the theoretical value of the currency and the actual one, supported by the central governments, right? So what do? Again, you short it. There's a problem when you short the British pound, which is what? You're going against the governments. It's as if I go back to Citibank and said, I short Citibank. Well, the stock went from 3 to 12. Right? So it's a very risky trade. And how can you hedge it? You can't. There's no way to hedge it. There's no convertible currency bond something. It's a different market. So what do? You just take the risk. Investing is taking risk into return. When you can, and if you're smart, you minimize the risk by hedging, by diversifying, whatever it is that you do. But in this particular trade, where your analysts are convinced that the British pound is overvalued by 20%, what do? There's only one thing you can do, which is to short it, break. Right? But they're unique. You're going against the government. It's a very bad idea to go against any government. Bad idea. Because the governments have tremendous resources at their disposal. They can buy British pounds like it's no one's business, and then that's a real squeeze. That's worse than a squeeze, right? Well, what happens is that they were just there. I will save you a lot of the details that happen around or in the lead up to September 17, 1992. When in September 17, 1992, they pushed after a very, very difficult day for the Bank of England, they decided to stop supporting the British pound, let it float freely, and then it was devalued from 15 to 25% depending on the currency. And then George Soros made a lot of money. I don't know how much money. $1 billion, $2 billion, $3 billion, something like that. Understand? Now, it's this is the story. This is the way of telling that. One of the things that I always recommend that you do is always think when you read something, okay? And when you do anything, always think. And it's very interesting how this story is written by by people that don't really understand trading, right? For example, there was this article, they referred to George Soros as the person who brought the Bank of England to their knees. Have you seen that? How can you bring the Bank of England to your knees? You can't do that, right? You just had the rate analysis, right? 2 plus 2 equals 4. If the Bank of England insists that 2 plus 2 equals 5, you say, well, you know what? I want to short your 5. I'm going to go long my 4. You understand? That's what we've done today. Just that in this particular case, of course, he didn't make a lot of friends by doing that. He made a lot of money, but not a lot of friends, right? And in general, I tell you, it's a bad idea to go against a government because usually that doesn't end well for you. But in his case, he was not the only one. They also say that, I mean, his position was around $10 billion, euros, pounds against the British pound. The daily volume is about 200 billion. So there's no way you can affect the markets with a position which is 5% of the daily trading volume, right? So, there are many. I like to quote these wrong stories, and I don't know if it's bad journalism. It's just the people that write these things don't really know what they're writing about. You know what we're writing about. Another one of my favorites, I don't know if I think I told you, is the formula that destroyed Wall Street because someone came up with the Gaussian copula. I think I told you about that, right? It was in the newspaper also. So, no, you know better now. You are able to now go into these things and analyze all these things like we have done here. Where these are trades, and you take risks. In this case, he took a very big risk, and he could have lost a lot of money, right? But he was right in his analysis. Okay, so that's another example. This is called global market. They are managers. That's all they do all day long. They say rates are too low. They have to go up. Gold is too high. It has to come down. And then sometimes you can hedge. Oftentimes in global macro, you cannot hedge. You go short gold because you think gold is overpriced and, inflation is just going to disappear or something. And then maybe you're right, maybe you're wrong. But some other times you can hedge, like in the case of the stocks, convertible bonds. We've seen the full suite of activities today. I want to end quickly. Okay, I want to just go through this. I want to end with one of the examples that I think is most interesting about all of these things. And I told you, and I remind you again, when it's time of investing, being smart outperforms every other activity, including making mathematical calculations. Okay? And this is one of my favorite about being smart. It's another story, also about 2008. On Friday, March 14, there was another interesting announcement. Most announcements were on a Friday or Saturday or Sunday. And then Mondays where people were just trying to catch up and figure out what the future was going to be. Wednesdays were not very interesting. By the way, that day I told you, August 13, also Wednesday. So Wednesdays were the quiet days. People were wondering, okay, what's going to happen this Friday, And they finally recovered from whatever developed on Monday. So on Friday, there was the situation was that this bank called Bear Stearns, that I'm not sure if you're familiar with, was a big broker. It was in very, very bad shape. There was rumors it was going to go bankrupt. It was in very, very bad shape. Turns out that there's a security called a credit default swap that we have not seen in this course, but now we see it here, which essentially is insurance against bankruptcy. If a counterparty goes bankrupt, you get paid some money. Let me just say it like that. Okay, the credit default swap. And they trade at a certain price. And in this case, the price was 10% of the national upfront, which is if you want protection against $1 million, you're going to pay $100,000, like insurance. Yes? All right, great. So that was there, and hedge funds were selling this to people who wanted to buy it. I suspect not only hedge funds, I suspect insurance companies were doing that too. In the case of Lehman Brothers, the CDSs were being sold by AIG, the American Insurance Group, which is, Lehman went bankrupt on September 14. They went bankrupt on September 16, like the next day, because they didn't have the money for all the claims that those CDSs were going to be. But this is different. It was before that. and it was with Bear Stearns. What happened? What happened is that the Fed was interested in rescuing Bear. There were two big brokers in the U.S. that were in trouble: Bear and Lehman Brothers. I will omit the differences between the two, but the Fed was happy to bail out in a certain way Bear and just ignore, in a certain way, ignore Lehman. I'm not talking about Lehman, I'm talking about Bear. And what the Fed did is negotiate and basically encourage JP Morgan to buy Bear Stearns for $2 a share. The comment was that they would be lenient on some of the capital ratios, because we've seen that also in our course here. If you are a bank and you buy another bank, all of their liabilities, all of their bad stuff now hurts your capital requirements, right? So they were given some, I don't know the details of that, but they were given apparently some leeway as to how to deal with that. So they were happy to buy Bear Stearns for $2 a share. And that was announced on Monday, March 17. That was a great deal for everybody who was selling CDSs on Friday, because those CDSs sold at 10% were now worth 1%. So you're making 900% return on something over a weekend, right? But of course, that is after the purchase takes place. And the purchase of a bank by another bank, on the one hand, needs regulatory approval. They had it, but it needs shareholder approval. The shareholders need to be convinced, right? So it was still not a done deal. Shareholders need to be convinced. Turns out that I'm there, and then you see that the price of Bear Stearns stock, it trades at $2, $3, $5. For a minute, it goes to $10. Why? I didn't understand. I started to look. I mean, this is my story. I'm telling you. And then this is what I don't have a resolution of it. I don't know if you ask ChatGPT what they will say. I don't know how remote this information is. But then what you found is that many of the hedge funds that were selling the CDSs on Bear at 10% upfront were buying the shares, overpaying for the shares, just to vote in their shareholders' meeting in favor of the merger. See that? That's not in any equation I've shown you in this course. But this would be a theoretical gain which would not come to fruition if the shareholders vote in favor. And who knows, maybe they vote in favor. Maybe they think $2 is not good enough. If you're a hedge fund manager who's making money on the CDS, what do you care about $2 or $3? You're making 900% return on your CDSs, right? Lose money on the shares, big deal. You're going to make money on the CDS. You understand? You got to be smart. And I hope that's the other thing that you'll learn from this course. So I think that's a good way to end today, okay? This is also the end of the technical part of the course. I hope you feel powerful. The whole point today is that I want you to realize everything you've learned and how it can be used in all sectors of the financial sector. And you will be there and you'll be hopefully thriving and doing very well. On Monday next week, I will talk about communication skills, which is that thing without which everything you've learned here will be worthless. So that will be the way to end this course. See you Monday.